Welcome to the LivXplore Podcast. If you like what you hear, please hit like and subscribe. Welcome, everyone. I'm Sean Payne, owner and founder of LivXplore Real Estate and Lifestyle. Today, I have with me our co-host, Isaiah Chass. Isaiah, thanks for joining us as always.
Of course. We got a cool podcast for you guys today.
I need to come up with a different introduction because that's kind of getting lame. It's just...
we
do this together. What do I gotta figure out a new introduction. Anyway, on that note, we have done investing in real estate before, talked about private money, things like that. But we thought now would be a good time to go into investing in real estate for strategies from beginners to pros that way, just kind of cover the gamut. And so real estate really depends on your risk that way, how much risk you're willing to take. And, just like any portfolio, whether it's a stock portfolio, usually you try to strike a balance between like high risk and low risk investments that way. And but it has to be tailored to your risk tolerance. That really lays the foundation for how you're going to invest in your long-term strategy. And and your risk tolerance can change over time. So while real estate is a great way to invest in property, you have to figure out like where you're at in life and what's important to you. So, on that note, like often your risk tolerance is shaped by your financial goals, your personality, your personal situations, things of that nature. And like I said, that changes over time. So, Isaiah, you're at a different point in your life than I'd say I am, and you're maybe more willing to take on some risk. What am I saying? I'd still take on some risk that way. But
it's not a one size fits all though.
Right, exactly. As you get older, you may not want to take on those risks. You may want to be more protective of your financial situation that way. Certainly, personality plays a lot into it, and some people, like to play it safer, and some people like to take on more risk and can sleep at night. So that really comes down to like personally what your personality and what it entails that way. So I kind of jumped the gun a little bit. Real estate can be divided into low-risk investments and high-risk investments. The difference is that the low-risk investments are going to be more of a sure thing, but you're not going to get the rate of return that you wanted on that investment. Where the higher risk investments, you're going to get a better rate of return, but it's going to involve a lot more speculation that way. So again, you got to strike a balance, figure out what's important to you, and strike a balance that way. Diversification, spanning different property types and locations, are ways to curb your risk by offsetting potential losses with gains. And like I said, as life shifts, that'll also alter your risk tolerance. And it's important to regularly assess kind of your risk tolerance, and that's going to affect how you're going to invest in real estate that way. So
definitely. And we'll see with clients that we've had that as they get older, they'll sell some of their rental properties and move them into properties that require less upkeep, less day-to-day maintenance, just because, as you said, their life changes, and as they get older, they want to change how they're dealing with that.
Right. So. And there's a wide variety of different types of investments. Like I said, some are lower risk, some are higher risk that way. Why don't you go and talk about kind of some of the different investments that way?
Certainly. So with real estate, there's so many different avenues you can go. Just like in the stock market, you could go into so many different sectors to diversify or just be focusing on one. On the residential rental side, there's short-term rentals as well as long-term rentals. Short-term rentals typically being less than 30 days. Long-term rentals classified over 31 days, but oftentimes they're anywhere from 6 months to a year. And a lot of times those leases will continue even after a year.
Right.
Some people have tenants for, 10, 15 years. So each of those have different rate of returns that you can talk about if you want to go into that.
Let's see here. From a long-term real estate investment standpoint, and there can be a lot of variables. And I would say often in California, our prices are so much higher that way that you don't get the same rate of return that you do on a yearly basis that way. Your rate of return may be a little bit lower, but what happens is there's kind of a blend is like when you sell a property, that rental property in California, things tend to appreciate more here.
Right.
So that way you can that way you can, your rate of return can come off the equity that you've built more so than in other areas outside of the state where you may be getting a better rate of return on a monthly basis.
And that's a great point too, that not everyone looks at. Everyone says, where's the best place to invest? And it's not really a one size fits all, because there's different ways, whether someone just wants to generate rental income as if it's an annuity,
right,
or if they want to look at a long-term appreciation, whereas, you could buy a property much cheaper in Arizona and probably get pretty good rental income,
right?
But it might not have the same appreciation that it would within the Bay Area.
Right, exactly. That's it. And so, like, talking about appreciation, I tried to look this up before. At one point, the California Association of Realtors does or did keep the statistic, and I used to have this like somewhere. I couldn't find it. I went on CAR's website, and currently it's not there. They're just all about current statistics. But CAR kept track of or tracked single-family households from like 1964, 1965 up until a few years ago was like the last time I saw it. And on average, real estate appreciated about 4% here in the Bay Area that way. And that was over the course of, again, like 40 years that way. Now, what's happened, we have this huge need for inventory. And so, I can't remember, 2015, something like that, things totally changed. And it seems like we've been experiencing much higher appreciation since then. So take that into account. But on average, since the 60s, generally 4% appreciation that way. So let's jump into the different types of investments. So as you talked about short-term investments here, short-term rentals, they're going to get you a little bit higher rate of return than the long-term rentals. But again, that there's more risk involved,
and a lot more work involved.
A lot more work involved, and just making sure that you keep that filled. Seasonal changes that way, rather than having someone locked into like a 6 or 12-month lease that way, where they're going to continue to go through. Again, where you own this property and where the property location is, the desirability of that area being at like a secondary home market, that's going to affect your rate of return. If people like to go out there on vacation, that's going to affect your rate of return. But we're fortunate to be in Sonoma County here, and at one point, I would say, when Airbnbs like 5 or 6 years ago became really popular, the appreciation people were experiencing like in Healdsburg was just crazy, right? But right now, I'd say closer to 8 to 12% is what people can see year over year. And again, that may change. I know that as the economy potentially dips, we're anticipating less reservations in the short-term rental market, so that's going to affect rate of returns. Exactly how much I haven't known, but in recent years, I think 8 to 12% is kind of a good base to start that way. Long-term rentals, again, it's going to be a safer bet, but you're probably looking 6 to 10%, and realistically, maybe even 4 or 5, 6%. The way the prices again have gone in California, you're going to be for long-term rentals, you're going to be on the lower end of that. 4 or 5, 6%, somewhere around there. Again, you recapture. You capture that rate of return back when you sell the home. You have that equity that way. But if you go out of state, and I used to say Texas and things like that, but prices have gone so crazy up there, or down there. But certain states you're going to be able to get, like you said, a better rate of return. But when you sell, you're not going to have that equity that way. So 6 to 10% is going to be more likely for a long-term rate of return that way.
Right, so. And a lot goes into that as well with how much you put down, what's your interest rate for your net income, like over the course of the year,
right?
Compared to your gross rental income, will depend on down payment. Monthly payment from the down payment and the interest rate they're dealing with. So those are all factors to put into play.
Sure.
So we have rental properties. That's, I'd say, the most common form of investment for investors looking to get into real estate. But there's a lot of other different ways. Another one that is certainly gotten a lot more attention is flipping.
Yes.
It takes a certain type of person that's comfortable with doing that. You either have to be very good hands-on, being able to do the work yourself, put sweat equity into it, or you have to have a really good team around you that you can do a lot of that with at a much cheaper cost than if you were to go out and do it. For example, if right now we see building costs and construction costs so expensive that if you were to go out and just hire a contractor to do the work for you, like any other deal, you're probably not going to make money on it.
Right.
But if you have a team that you work with closely, that you do a lot with, and they help you out and you help them out by giving them so much work, then it's something that, you might be able to make money on. Similarly, if you do it yourself, that's a lot less of the equity they're cutting into.
Right. Or, a lot of cases, you have, a flipper may buy materials for 10 or 20 homes, right? Like at bulk, and then anticipating they're going to flip those homes. That's why you some flippers you walk through and you're like, I know who did this flip, right? It's similar materials that way. So there's a lot of little tricks to the trade. It is harder as a mom and pop, a small time contractor to do it. I would assume that part of this is it can be lucrative, but you're speculating. Right. And also I would assume that in real estate investments, probably more money's been lost from just mom and pop investors and flips than in other things. Right. Because especially with the reality TV shows of the last 10 years of just making it seem like it's just the best career in the world. There's a lot of things that can go wrong.
Well, especially in a market similar to what we've seen in the past, 12 months where there's a lot of unknown. So if your project is not taking a month or 2 months, even 3 months to complete, no one really has a firm grasp of where the market could be in 6 months from now. So you're taking a lot of risk if you're taking your time to do that remodel and you don't know what could happen in 6 months from now. I mean, there could be an interest rate hike and the market slows down a lot during that time. So there's a lot that goes into that as well.
Yeah, I think people have been very fortunate since the last foreclosure crisis that they really haven't had a lot of dips in the market. So they've been, their speculation has been right that way. But at some point, things can get a little wonky that way.
Right.
But talking about the rate of return, so for the larger companies, the larger construction companies that were doing a lot of flips during the foreclosure crisis, I would say that 20% was kind of the average that way. And talking to some of the bigger conglomerates that still do this, I think 20% is still kind of the industry average. And then it drops down to what person's their risk tolerance is, right? How much risk they're willing to put out for this for that return. I would say that 10 to 15% is probably more of what a lot of the smaller smaller construction companies or the single person is looking to obtain that way. And that 10% that can shrink really quick if you make a mistake, right? So that's why there's that risk there. So.
Yeah, and a really good piece of advice with that is talk to someone within the industry that is has a very good understanding of the market. And if it's going to be a flip, think about things that will be an issue in the future. Like we always talk about driveways. So if you might be able to get a really good deal on a property, but if there's going to be a hurdle that you're always going to deal with, no matter what you're doing to cosmetically fix it up, it's something that you should talk to someone and see if there's any underlying issues that are going to affect value in the future if buyers are going to be picky.
Right, exactly.
So we have rental properties on a short-term, long-term basis, flipping properties. There's also REITs, real estate investment trusts. So that's more, I would say, for the investor that wants to be more hands-off. They don't want to deal with either the managing of tenants or managing of the remodel process with a flip. So the rate of return can be lower on those, but there's also, it's very similar to a stock essentially, where there's nothing that you have to do on a day-to-day basis. So really a REIT, a real estate investment trust, it's a company that buys real estate and you buy shares in essentially that company. So you diversify by the fact that you're investing in multiple properties, but you don't you don't, I don't know the right way to say that, you're not solely in one home or one condo.
Sure.
It's spread across, and that could be spread across commercial properties. That could be spread across just residential properties.
Nationally, it can be in
all
areas,
over the country, and some that you can even be spread with commercial and residential.
Right.
So that also is factoring into your risk tolerance, whether which type of diversification of a REIT that you want to deal with.
Sure. And with real estate investment trusts, again, this can be all kind of all over the board, but somewhere between 3 and 7%. But total returns can be different when you factor in like dividends and potential capital appreciation that way. So again, I would talk to someone. Real estate investment trusts aren't our specialty. So if that was an area that would interest you, feel free to reach out to us and we can put you in touch with someone who is an expert in that field. But that is a little bit different than normally what we deal with that
right.
way. So,
definitely more hands off, a lot more like any other stock. But if you're interested in real estate, it might be an option for you.
Right.
So I think lastly, if you want something different than what we've talked about, I would say this is probably more for the savvy investor. There's a little more that goes into it, but commercial space, office space, which I'd probably be careful about right now with all the vacancies that we're seeing nationally. But office space, storage facilities, retail, storefront. There's a lot of different types of commercial space, but there's definitely a lot more that you need to have an understanding of going into that, because it's not it's not cut and dry. Right.
Yeah, and rates of return on that I think are all over the place, especially now. Like you said, like commercial space, we're experiencing somewhat of like a little foreclosure crisis in the commercial sector. So previously, historically, I would say like 7 to 10% is what you could expect from a commercial property. We have to get maybe Alan in here to talk a little bit about what he's seeing locally in terms of rates of return. But I would assume that's dropping again because we have a lot of foreclosures and empty space right now. That's going to continue for a while.
Yeah, and that will be a great separate podcast. But we're seeing, I'd say daily, something in the news about a commercial building being defaulted on.
Yep.
And again, there's a lot more that goes into that, but something to be careful on if you're looking to invest in commercial space.
Right. Yep.
So again, all of these are really good options depending on what you're looking for. A couple stories that we've had clients that bought multifamily properties, were able to rent it out while they were doing the remodel and cover their, I guess you could say, holding costs of holding the property while they were doing the remodel from the rental income, and then sell it for a profit once they did the upgrades. So that's one way that you can get into the rental side as well as the flip side. We've also had clients that have bought turnkey properties that are single family homes that there's nothing that you need to do to. The second they close escrow on it, they can place a tenant in it and have no work that really needs to be done other than managing the property. Or if they could have a property manager, then they are very hands-off. And both of those are ways to generate income, but they're very, very different. One is a very hands-off approach, and the other is a lot more involved within it, but there is more potential for generating income from doing the multifamily fix-up.
Right. Yep. More risk, more reward that way. So yeah, kind of just recapping, when you're thinking about investing in real estate, you have to figure out exactly what your risk tolerance is. And you want to conduct thorough research, consider evaluate your local real estate market, look for potentially anything that can come up down the future, what's affecting the real estate market. If it's for example, if it's a rental, are there rental restrictions going to be put in place? What's it going to look like, 12, 24 months down the road? No one has a crystal ball, but try to figure that out. And I think the most important thing is, how do you do that? Work with a local real estate consultant who's good at what they do, that's worked in investments in the past that way, that can analyze it for you. Again, no one's crystal ball is 100% clear, but someone's going to be able to give you an idea of, hey, this is what's currently going on in the market. Potentially, we have these restrictions in the short-term rental market. We have these, tenant laws in the long-term rental market. You can become educated and then kind of figure out, okay, well, that ups my risk, so I don't like that, and I want to go this way. Things of that nature.
So. And there might be some opportunities to buy it in that because other investors will get spooked by it.
Yep.
And if you're comfortable with that risk level, then you might be able to jump in when others are are leaving.
That's a very good point. Very good point that way. So if you have any questions about real estate investments or rates of return, anything like that, we are here for you. Feel free to reach out to us. If you have a specific property in mind, we have various programs that we can show you a rate of return, and we can cast it out 10, 15, 20 years that way. So feel free to reach out. I think that's pretty much it for today. So I'm Sean Payne, owner and founder of LivXplore Real Estate and Lifestyle. Thank you very much for following us today. If you enjoyed this podcast, please hit like and subscribe so you'll see more content in the future. And Isaiah, thanks for joining us.
Of course. See you guys next time.
All right. Bye, guys. Welcome to the LivXplore Podcast. If you like what you hear, please hit like and subscribe.